Hello traders, Gary Wagner here, just about 10:40 in Honolulu, 3:40 in New York. It is Thursday, February 18th, 2016, and this is the Daily Report for Gold and Silver. Tremendous rise today in the precious metals markets, with gold being the most stellar performer of the complex group: platinum, palladium, gold, and silver, of course. Currently, we are looking at gold trading up roughly $25, $26 on the day at $12.34 and change. Now, it's traded to a low of $1,200, so we've seen a pretty decent range. The high, $1237.11, so we're just a few dollars, about $3 off the high today. This, of course, all on the shirt tails of a statement made by one of the Fed presidents in St. Louis, in which he stated that he doubts we'll see an interest rate hike likely in March, and he's looking for the yearly total to be about 25 to 50 basis points, or about a 0.5% increase, which is a lot less than previously perceived or believed. On today's show, I want to review our current trade. Of course, we did go long yesterday, roughly at 12:08. We have stops in place at 11.89. We'll address the stops. We'll address our upside target, which is, of course, our exit strategy, all on today's daily report. So traders, first chart that I do want to look at today is a simple intraday chart, 480 minutes in terms of the cycle. But what I find interesting, and it's clearly revealed, of course, I believe, in this particular chart, is our handle right here and, of course, our cup. So as I said, what I think that we're seeing right here in terms of a straight pattern is a pattern simply called a cup and handle. Now, obviously, when you look at the handle, you look at these highs here, and those highs, which come in roughly at about 11.80, that's the point. If you exceed, then you're looking for a breakout on this particular pattern type. And although we pointed it out, roughly, I think about a week or a week and a half ago, maybe 2 weeks, that we saw this pattern in the marketplace, it's worth noting now that we've had this defined breakout to the upside in that particular chart. It's very, very visible. Next chart I want to look at is a chart that we kind of pulled out yesterday. And the chart itself is I set it to 440. It's a daily chart, and the reason is my daily charts don't seem to be updating. And along with that, I've got a fib extension, and that kind of leads us to our upside target. Just to kind of quickly review, if you recall, we've had a couple of pretty decent trades in the market. Our first set of trades really came in at around, call it right in here at 10:11. That was on a Monday. Of course, on the Tuesday, we sent out a special trade notification because we mentioned it on Friday. We mentioned it on the show on Monday, but we didn't send out the trade alerts. Traders that took that got in at around 11:17 rather than 11:11. And then as this market rose and I saw a real nice breakout developing, we actually added to that position. Now, we rode that position up, and when my first level that I had perceived to be some sort of potential resistance, which we never really saw, which came in roughly at around 11.61 or so, we did exit half of our position, meaning that we covered half, we let the other half run, and then as this marketplace came up and hit these highs at around 62, of course, we went ahead and we raised our stop to 12, we go through these numbers so quickly, but 12.31, I believe we had it at 12.29. So in essence, we got in this area here. As it came back down, it stopped us out right at about 12.29, and we sat on the sidelines for a period of 1, 2, 3 days. And yesterday we sent out a trade alert. It was an aggressive trade alert. Now, hopefully you have a second to talk about that. But the reason that I reacted and sent out a official trade alert on an aggressive call was because the aggressive call really talked about or looked at the candlestick pattern that formed. We didn't get our confirming candle, but so many other parameters were being met, And specifically, one of the main parameters that I looked at was the way that the wave count itself was unfolding. And in essence, what we saw was a nice rally, a 61% retracement, a 261% extension, and from there we saw a 38% retracement, this being the 38% retracement at 1189, which is why our stops went right under there. Now, we were looking at the screen candle, and if you recall, or you can just, if you didn't look at it yesterday, go ahead and pull up yesterday's show. We actually draw in this candle as our defining parameters for a conservative call, obviously, which is a higher high, higher low, and a green candle. We certainly got that today. Anyone who did not take that call yesterday certainly took it this morning, but I imagine that many, if not the majority of our subscribers took this call yesterday. We got in roughly at 12:08, so we got in near the high of this candle. And the interesting thing is, when I watched this market trade overseas last night, at the beginning, it was up a little bit, maybe $1, $2, and then I actually saw it come under some pressure, starting to trade $2 to $3 lower. I saw it print down to 1,200, and at that point, I questioned whether or not we got in too early. Of course, even traders have to sleep, so that was when I called my 7-8 hour period of rest. And when I awoke early in the morning, I was quite surprised to see the kind of move that we saw, and it was a very, very pleasant surprise indeed. We now have this market, as you can see, trading at 1238.80. It is near the highs of the day, and as I said yesterday, in terms of my upside targets, I am really looking at the potential for this particular wave to go anywhere between 100 to 161% in terms of the range and extension of wave one. Because in Elliott Wave, typically what we do is we create a benchmark, and that benchmark is the open or the start to the end of that wave one. We measure the range that it moved, and then we apply that for all of our subsequent forecasts and modeling of the Elliott wave count 1 through 5, except for wave 4. So you get wave 1, and then we're looking at a percentage retracement of wave 1 to conclude wave 2, 61%. We then take a look at wave 3, and so we look at the extension of the wave 1 in comparison to wave 3. As I said, wave 4 is unique because we are looking at the correction of wave 3. It's the only wave that we really don't use the benchmark wave 1 in terms of our modeling. And then, of course, our final fifth wave is typically between 1 to up to about 1.61% that of 1. Now, when you have the kind of extended range that we saw in this wave 3, this is a tremendous move because typically you'll see 1.31, you will see 1.61, but here we got a tremendous rise. We actually got a range of 2.61 in terms of the actual extension here. In terms of our stops, our stop is sitting under 1189. Now, the only real place that makes some sense in terms of moving it would be to move it under today's low. We've had a dramatic rise today. You can move it under 1200, but officially we're going to see what happens tomorrow. I'd like to tighten it up, but I want to tighten it up based on some of these lows if we see a continuation in terms of the kind of strength we saw in today's market, now trading at 1240 per ounce. This has been Gary Wagner, wishing you as always good trading. We're certainly getting that today and this month. We'll talk to you tomorrow for the weekly wrap-up and review. Bye-bye.